Hello traders, you are welcome back to the Forex Geek channel, and in this particular video we are going to be talking about a powerful reversal tool for gold. And the tool, to be specific, that we're going to be talking about is the RSI Divergence. Okay, the RSI Divergence is a popular concept, and that's what we're going to be discussing in this video, but specifically within the context of gold trading. Now, divergence gives traders early signals that price may reverse, okay, not based on guesswork but based on momentum shifts. So let's just break down exactly how to use RSI divergence effectively on gold. So because of that, I have to add the RSI indicator to the chart as the relative strength index. Okay, RSI stands for relative strength index and it measures momentum. Okay, it's an indicator that measures momentum. RSI divergence happens when price makes a higher high but the RSI makes a lower high. Okay, sorry about the RSI. It seems like it's still loading. Okay, sorry about that. Let's just remove it and put it again. Perfect. So now, whenever price is making higher highs and higher lows, and you have the RSI making lower highs and lower lows at the same time, it is called a divergence. Okay, or when the price is making lower highs and lower lows, and then you have the RSI forming higher highs and higher lows, is also called the divergence. Okay, there is bullish divergence and there is bearish divergence. So that disagreement between price and momentum is a major clue. It tells us, I'm trying to see if I can find a good example. It tells us that price is still moving in one direction, but the momentum is fading, and that often leads to a reversal. Okay. Um, let's go to a lower time frame. Let's see if we can find a good example. Okay, let's go to 1 hour time frame. So in this particular example, we can see that the price was making higher highs. For a bearish divergence, the emphasis is on the highs. Okay. So price was making higher highs, but you can see that the RSI made lower high. All right. So this shows that in as much as the price was still, in a bullish trend, the bullish momentum was already getting weak. So because of that weakness in the bullish momentum, we are expecting a decline. And you can see that price eventually dropped, right? Price eventually dropped, okay? Now this is a bearish divergence. And then in the case of a bullish divergence, it's when price, price makes lower lows. When price makes lower lows, but then you have the RSI make higher lows. Yeah, this is a bullish divergence showing that price is likely about to go up, and you can see that's exactly what happened. It shows that the bearish momentum was getting weak. Okay. Meanwhile, these examples I just showed you are examples of regular divergence. Okay, because we have two types of divergence. We have the regular divergence, which is used to spot trend reversals, and we have the hidden divergence, which is used to spot trend continuation. Okay, so these ones I showed you now are the regular divergence, which is used to spot trend reversals. Okay, now gold is a volatile asset. It respects momentum indicators like RSI, especially on key time frames like 15 minutes for scalping, 1 hour or 4 hours for swing setups, and the daily for trend reversals. Now, because gold reacts strongly to news, inflation data, and risk sentiment, it often overextends. Okay, and RSI divergence helps you time the snap back. But don't take every divergence signal blindly. Okay, it works best with confluence. So here's a simple framework. Okay, here is a simple framework. You plot your RSI on your chart. All right, plot your RSI on your chart. You can use the 14 period or the 21 period RSI. Okay, if you want to edit that, you can see the RSI length. You can use 14 or you can use 21. Then you wait for price to make a new high or a new low, but RSI does the opposite, just like what happened here. Price made a new low, but RSI made a new high. Okay, in this other case, where is it? In this other case, you can see price made a new high, RSI made a new low. Okay, so you wait for such to happen. Then once you have done that, you mark the divergence zone. All right, you draw a trend line connecting the RSI points, and you draw a trend line connecting the price points as well. Okay, so after doing that, you look out for confirmation. Okay, look out for confirmation. You could have a confirmation maybe from a candlestick pattern. If it's a bearish divergence like this one, you can watch out for maybe a bearish engulfing. All right, you can probably look out for a bearish engulfing or any other bearish candlestick pattern. If it's a bullish divergence, like this one, you can be looking out for maybe a pin bar or bullish engulfing or any other bullish candlestick pattern. Basically, when you get your confirmation, then you can go ahead to execute your trade. Make sure that you have a confluence. Is price near a supply or demand zone? You watch out for whether price around the supply zone or demand zone, and then you can also decide to use Fibonacci maybe for additional confirmation. Okay, also you watch out whether you are near a previous structure. Once you get your confirmation, basically you take your trade in the direction of the divergence. All right, and then once you have done that, you place your stop loss just beyond the recent high or low, depending on the direction. So if it's a sell trade, your stop loss can be above the recent high. If it's a buy trade, your stop loss can be below the recent low. Okay, then for your targets, you can use previous swing points, you can use measured moves. You can just trail your stop to follow the move. Okay, always manage your risk first. Divergence is not 100%. It is a signal, it is not a guarantee. Then now let's just briefly talk about hidden divergence. Okay, it is when price makes higher low. Remember I said regular divergence is for trend reversals. Here we are having a bullish trend, but then after we got this bearish regular divergence, we had a reversal to the downside. Here we were having a bearish trend, right? But after we had this bullish regular divergence, we had a reversal to the upside. But hidden divergence is used for continuations, trend continuations. Okay, and it occurs when price is making a higher low. Sometimes hidden divergence might not occur very frequently. Okay, but just in case if I see any, I would actually like to show it practically. Okay, hidden divergence is when price actually makes a higher low, all right, but the RSI makes a lower low. When price makes a higher low, okay, I think I can see one hidden divergence here. Okay, all right, now you can see that price made a higher low here, but you can see that the RSI made a lower low here. Can you see that? So when you notice this kind of situation, this is for a bullish, a bullish hidden divergence. So it shows that the trend is still going to continue upward. This is not a reversal. This is a trend continuation signal. All right. The reverse is the case for a bearish divergence. That is a hidden bearish divergence. This is a hidden bullish divergence. Okay. So you can use it during pullbacks in trending markets to find entries with momentum. Combine hidden divergences with maybe EMAs, or trend lines for stronger setups. Don't just rely on the RSI alone. Combine it with structure, candle confirmation, and key levels. Right? RSI divergence, trading gold is quite a high probability setup, especially when the market is overextended. So if this breakdown helps you sharpen your gold trading edge, click the like button and subscribe for more deep dives into smart trading setups. See you in the next one.